This is the third part of the three-part series on how to trade stocks as a beginner. In the last part 2 in this three-part series, we covered charting, we covered a setup that I trade, and so this is going to be after you have identified a setup on a chart. Where am I going to be right? Where am I setting my take profit? Where am I going to be wrong? Where am I setting my stop loss? So this is the example I'm going to use on ticker symbol WBA. I've gone ahead, I've set my levels here. So the intention is going to be to play a move back down to that low at 24.97. So this is going to be my take profit. And then on the other hand, this is going to be my stop loss at the 50-day SMA, okay? Resistance overhead at 26.36. Now, obviously, my intention here is to play a move to the downside, so I'm going to want to go ahead and buy puts, right? Puts, you're betting on the direction of a stock to go down, where on the other hand, calls, you're betting on the direction of that stock to go up. So I am doing my trading on TD Ameritrade's Thinkorswim platform. I'm not sponsored or endorsed by them. So if I head over to all products, well, what we're looking at now is the options chain. Now, if you want to learn about options, I figured I didn't want to waste my time or yours. I did make a short video. I covered the basics when it comes to options in under 5 minutes. I will put the link to that video in the description below. But what we're going to want to do once we pull up this option chain is run through a series of contracts. We're going to want to simulate out that position with our stop loss and our take profit, or in this hand, our take profit and our stop loss, right? Because we're going short on this chart. And we're going to find the optimal contracts that we're going to want to end up buying. Now, when it comes to the basics of options, we know that the closer the expiration, inherently there is more risk, whereas the farther out that expiration goes behind that contract, those are going to be a bit safer. So we're going to be able to kind of gauge the risk to reward, if you will, based off of which contracts we decide to buy, where that expiration is going to be, and how far in the money or out of the money those contracts that we're going to buy are. And so essentially we're going to be able to gauge the risk behind these contracts by running through the simulation, with the goal being to figure out how much am I going to make and how much am I going to lose. So if I'm right, this is going to be my P&L. If I'm wrong, this is going to be my P&L. I want to quickly mention before we hop into this that there's a lot that goes into trading. And even though I can do my best to try to cover as much in this little mini series for beginners, there's so much more that you're gonna have to learn to become a consistently profitable trader. I literally spent a month to record an entire curriculum covering every single aspect of my trading system, from technical analysis, everything that we've essentially been covering in this mini series, to then risk management, trading psychology, filling in all of the blanks as to every piece of the puzzle which you will need to become a profitable trader. And that curriculum is located inside my mentorship group, which I will put a link in the description below too. It's not just a curriculum you'll get access to, but you will have access to see all of the trades I take in the stock market. So when I'm putting out a position, I post that entry, and then when I'm exiting that position, I will post that exit. So I'm either making money or losing money, and you will essentially have the ability to follow along and copy my trades if you so desire. Again, that will be the first link in the description below. Click the apply now button, fill out that short application, and if it seems like you'd be a good fit, someone from my team is going to be reaching out. And with that said, let's go ahead and hop on inside my computer. So let's just first start by going over to the Analyze tab, okay? Under Risk Profile, this is where we're going to be able to simulate out any contract that we'd like to see. Because based off the contract you buy, even though that target is going to be the same on the chart, okay, for your take profit or where you're going to stop out, well, based off of the contract you buy, that is going to vary when it comes to the profit or the loss behind that position. Okay, so for example, if I add a simulated trade here, let's just go with the September 8th contracts. Okay, obviously I want to buy a put, and now these blue contracts are going to be in the money, inherently safer contracts, and then the darker contracts are going to be out of the money, so a little riskier. What we're going to want to do is find the optimal contracts to buy that present enough upside while minimizing our downside. Now, if you're not trading on Thinkorswim, you don't have access to this risk profile. However, there are many websites out there, option profit calculators, where you're going to be able to use essentially this same concept, the same idea, punch in your stop loss, your take profit to get the outcome on that contract's value. Again, where you're going to be right, when you're going to be wrong, how much you're going to be up, how much you're going to be down. So I'll put some links below to a couple of my favorite option profit calculators but I'm gonna show you how I go about doing this on TOS. So under price slices, these are gonna be the levels we're gonna wanna set. So 24.97 is going to be our take profit. And then 26.36 is gonna be our stop loss. So I've gone ahead, I put in 24.97 and 26.36, and then I've just zeroed out this last column. Now if I go back to risk profile, you can see up here, the date is going to be the expiration date on the contract you're choosing. And then down here, this date is going to be the date at which the calculations will be done. So say you enter this position today, well, we're able to see tomorrow, if I hit my stop loss, how much am I gonna lose? If I hit my take profit, how much am I gonna make? And then we can even go out further and see, well, Thursday, Friday, Saturday, etc. So I'm gonna go ahead and I'm gonna add a simulated trade on. We're gonna go with the September 8th contracts. I'm gonna go with the $26 puts. Okay, I'm just gonna make this one contract. Say we're gonna be buying one contract. The contract's value is 0.58. What does that mean? Well, in option terms, that doesn't mean 58 cents. That means $58. Because remember, options, you're essentially leveraging your money 100 to 1. You are buying one contract, which is equivalent to 100 shares of that stock. Now, if I go back to risk profile, so I have the September 8th, $26 puts pulled up. So we're gonna wanna go up here to date, okay? We're gonna choose September 8th. So the contracts that we're looking at right now are going to expire on September 8th. But let's say we entered that position today. Okay, the market's closed right now, but if we had entered this position today, today's the 30th, and we held this through Friday, and Friday, well, WBA moved down and hit our take profit, okay, or it moved up and hit our stop loss, we can see right here, per this one contract, this is gonna be our P&L open. So if we hit our take profit, we will have made $48.87. If we hit our stop loss, we will lose $41.79. So these contracts are only worth $58. We're gonna be losing $41 again if we get stopped out on Friday, which means we're gonna lose about 75 to 80% of this position. Not exactly, but all you have to do is go ahead and calculate, well, what percentage of $58 is going to be 41, and that'll give you your number on how much percentage basis you will lose behind that position. So that'll be around an 80% loss you're going to take on these contracts, whereas the upside here, our P&L open, we're going to be making around 85%, right? Just roughly. Again, these contracts are only going for $58 and we're going to make $48. So now we know on this trade, we're going to make more than we're actually going to lose, which is great, right? It's not the opposite where we're putting more risk on the table. We're gonna risk more if we're wrong than we actually have the potential to make. But I wanna show you how by just what I like to call manipulating the contract, which means running through a series of contracts, how that outcome is going to vary, maybe even drastically. And that risk reward can swing from, a 1-to-1 where you're essentially risking almost as much as you're gonna make to a 1-to-3 where you're risking that 1 to make 3. In this case, just if you don't know risk reward, kind of the basics is a 1-to-3 is gonna be risking 1,000, make 3,000. So there's way more upside than there is downside behind that position. Again, the idea here behind manipulating or running through and simulating a series of contracts is that we don't only just want to know how much we're going to lose if we're wrong and how much we're going to make if we're right, but we want to maximize the amount we're going to make while limiting that downside. So by just doing this, we could go from losing, like I said, 80% of the position if we're wrong to then just losing 40% of that position, which is a huge difference. Let's go with the October contracts instead, and we're going to go deeper into the money. So we'll go with the October 20th 3250 puts. All right, I'm gonna go ahead and uncheck with this previous set of contracts that we just ran. Instead of buying 10, we'll say we'll just buy 1. Go back to risk profile, and now we can see, well, okay, maybe this set of contracts is even worse, right? Because we're risking more than we actually have the potential to make. However, when it comes to risk exposure, what I mean by that is the upside and the downside percentage behind the contracts. On that previous set of contracts we just looked at, we were risking 80%. Whereas on this set of contracts, our risk is only going to be around 12%, right? Roughly $695 per contract, 12% of that, we're going to be in that $80 area. But on the other hand, like I said, the risk to reward here is kind of flipped, where we are going to lose more than we're actually going to have the potential to make. We could make around 8%. But literally just by manipulating or running through a different set of contracts, well, the difference between purchasing these versus the last one, we just went from potentially losing 80% on the position to now only losing 12% on that position. When it comes to risk to reward, there's a lot that goes into it, and I actually put together a video covering all of this. I will put that in the description below, risk to reward for beginners, but this video is focusing specifically on just how much I'm going to make if I'm right, but how much I'm going to lose if I'm wrong. And then by going through and simulating out different sets of contracts, trying to optimize and squeeze the most we can out of that position, while at the same time limiting our downside exposure. So let's try running through another set of contracts. Let's go with the September 22nd $26 puts, so one in the money. All right, gonna add these, uncheck that, go back to the risk profile. Well, now you can see, all right, these still don't look great. We're still risking more than we're gonna make. Okay, let's go through and run a different set. Let's go out to January 19th, 2024. Let's go a little bit out of the money with the 2250s. Again, we just want to look at one contract, back to the risk profile, and we can see, okay, well, we're still looking at more risk on the table than we can potentially make. Now, I do want to note, you can only manipulate contracts so much, because at the end of the day, when it came to setting this stop loss, okay, and this take profit, well, there is this margin on the chart where if, say, that stop loss is 1% above where you're currently trading, and then the take profit is 1% below, right, if we're short, well, we could see that there's a 1-to-1 as far as percentage basis to be covered up to that stop, down to that take profit. And that means that the contracts that we pull up will present around a 1-to-1, but based off of the Greeks when it comes to the option contract and how it moves, we could find contracts that instead of presenting that 1-to-1 could present a 1-to-2, and then obviously referencing that risk exposure to see how much we'd either make or lose percentage wise behind that position. But you don't ever want to go about actually changing these hard and fast levels, right, that we've set. We're not going to go and say, hey, well, I magically am going to put a stop loss level here at 2605 because the risk to reward is better when I go about simulating those contracts. Well, no, we can't actually identify any resistance on the chart here. So that would just be making up this level to justify putting on the trade because the risk to reward looks better, when that's not what you should be doing at all. What you should be doing is running through these different sets of contracts. All right, still running through contracts based off of this position. I don't think I'd be able to put on this trade, because no matter how many contracts we run through, it seems like we keep running into this issue of we're either risking more than we could potentially make on that position, or we're going to be able to make more than we're risking. But if we are wrong, the actual risk, right, the downside percentage basis is going to be so great, for example, 80%, that it's just a trade that I would never put on in the first place, because knowing that there always is this potential, this chance that we're wrong, we don't want to risk 80% of our position. In this video, again, I'm trying to emphasize the point behind knowing exactly how much you're going to make, how much you're going to lose, and then that you do have the ability to go ahead and squeeze the most you can out of that position while limiting the downside on that trade. So after you have gone about manipulating these contracts, you've found the contracts that present the most upside with the least downside, you can go ahead and enter that position. That is going to wrap up this 3-part series on how to trade stocks as a beginner. I know this isn't typical to the normal video I film, as most of our content is kind of day in the life based, covering and showing you what it is like to live as a full-time trader in the stock market. We'll get back to that next week, don't you worry. But if you did enjoy this mini series, if you guys want to see more from myself, don't forget to subscribe, smash that like button, and again, the first link in the description below will take you over to my mentorship group, where you can learn a bit more as to what is actually included and go ahead and apply if that is of interest. With that said, I will see you all in the next video. Later.